Welcome to today's webinar. Today's webinar, tips for early stage entrepreneurs, use of proceeds from investment. The interview today is with Marco Rubin of CIT's GAP Seed Fund. Today's webinar is sponsored in part and funded in part through a grant award that CIT received from the U.S. Small Business Administration. CIT's mission, our charter, we are a nonprofit. We're creating technology-based economic development strategies to accelerate innovation, imagination, and the next generation of technology and technology companies across the Commonwealth of Virginia. Created in 1985, CIT is, again, a nonprofit corp, plugging the gaps at the earliest stages of the innovation continuum through commercialization and seed funding and other programs, as it helps entrepreneurs launch and grow high-growth technology companies and create high-paying jobs for the future. I'm Robert Brook. I'm the Director of Federal Funding Programs here at CIT. An overview of three of the key programs here at CIT that we manage that are geared towards helping us meet that mission. Our Federal Funding Assistance Program, again, which I manage, helps train and help companies and early stage researchers who are looking to learn about and apply for the federal SBIR, the Small Business Innovation Research and the Small Business Technology Transfer programs. Over $2.5 billion are available each year in these programs. Virginia ranks third in the country, typically between 120 and 130 million dollars are coming into the state from the federal government to fund early stage, high risk, high payoff research that has a commercialization direction. So my program is designed to help train and do workshops and webinars and mentor and consult and other activities. So please let me know if I can be of support on that. The Commonwealth Research Commercialization Fund, or CRCF, consists of 5 key grant programs for both early stage technology entrepreneurs and university research projects, with the goal of helping to develop a commercialization pathway. Those grants are between $50,000 and $100,000. The grants, the annual solicitation typically comes out in the fall of each year, with deadlines of early the following year, and then awards made sometime typically in June. So for information on the federal funding program as well as the CRCF program, please visit our website at CIT.org, and you can look at those initiatives. Finally, our CIT GAP Fund. GAP Fund is an investment seed fund making early stage investments into high growth potential companies, understanding that not every company is a fit for venture capital, of which the GAP Fund is. Makes typically, again, 50 to 200K investments into various technology sectors to companies across the Commonwealth, both for early stage as well as follow-on funding from investment we may have made prior. And the GAP Fund also manages the Mach 37 Cybersecurity Accelerator Program. Today with me is Marco Rubin. He is our Senior Investment Director for the GAP Funds. And thanks for joining me today, Marco.
You're welcome, Rob.
No problem. And I think that, one of the things is we're talking about the GAP Fund. This is a series of webinars we're doing with reps from our GAP Fund and other programs at CIT to try to show some of the different, from the people that we have working here, as well as some of the advice that we have and we can give to early stage companies. And one is you are part of our GAP Fund. I wanted to give you a chance to talk a little bit about your background, kind of what your experiences have been out there in the world of investing and other corporate activities. And then we'll go into a little bit of some of the tips you have for early stage venture capital seekers. And then from there, we'll go into a little bit about the use of proceeds, because I think that's an important topic that might be not really well thought of from those who might be thinking about looking at venture capital, other outside funding sources, maybe a few years from now, to how do you start positioning for that, thinking of what that money would be used for. So give us a quick overview of your background, Marco, and kind of what your roles, and also what your role here is at CIT, and then from there we'll move into more specifics of the use of proceeds.
Terrific. Glad to do so, Rob. So by way of background, I have about 30 years of experience. The first 10 years as an engineer. The past 2 decades have been largely in professional tech investing. I've been in a corporate venture setting, running a Fortune 500 corporate venturing arm. Then I was a partner with a VC firm, and most recently, since inception at CIT's GAP equity programs, 14 years with the core team here. So The point in all of that is my career arc has all been in seed and early stage tech investing. So the perspective I bring today and the conversation I bring today is from that of an investor that's done a lot of deal velocity. So just to give you a sense, and perhaps you've heard this from others, but at the time of this taping, we are at about 190 plus portfolio companies across 3 funds. So we have a life sciences fund, we have a software fund, and an energy fund. So those are the general areas, and my geographic area is the peninsula area, the Tidewater region. I spent a fair amount of time in Norfolk, Hampton Roads, Williamsburg, and other locale markets, and we are active in that market as we speak.
So so you mentioned that you have a sort of you focus on the Norfolk area, the Tidewater, the Hampton Roads region. We have other directors, GAP directors, that actually also have their own regions, but they certainly all look at deals across the Commonwealth as well when appropriate. A little bit about what are some of the traits, some sort of traits you like to see in a company that you're looking to maybe invest in? What is it? What are some of those intangibles that you sometimes it's hard to put a finger on why you like these guys so much, but what are some of the things you really that sort of excites you when a company comes to you, even if they're early stage, a one-person company? What might be some of the traits that you like to see?
Well, yeah, that's a great question, Robin. It's one of the areas that I really look for is authenticity of the story, authenticity and credibility of the entrepreneur. I'm looking not just for a good story that makes economic sense, but I'm really looking for evidence both in the presentation, but also during the conversation we have with people. So as we get to know entrepreneurs and hear their propositions, you get a really good sense during the Q&A interchanges how well these people know the market, if they've got a really good sense of the risks, if they've been there, done that before, or have another a pathway into the market. You get a sense of people's resilience, and you hear the word grit a lot too. You get a sense of how dedicated and committed are. So to your point about intangibles, I'm looking for entrepreneurs who have a very grounded sense of what the proposition is, because they're really talking about pretty much a key topic we're going to be talking about in a little more depth today, which is use of proceeds and other people's money. So I'm thinking about how this entrepreneur not only will create and grow a company, but will they be a good steward of the capital? So yeah, it's a great question. I look for that.
Okay. Well, thinking of use of proceeds, now we're talking here about an investment. On my role at CIT, I work with companies who are seeking some federal funding in the form of grants and contracts in the SBIR CTR program, which are, $150 to $1 million, grants or contracts. Then they don't owe the money back. The government's not taking a percentage of the company. However, even in that realm, there are expected, or actually they have laws that they have to follow of what you can and can't use the money for. Typically, it's very research, man-hour focused use of proceeds, so to speak. Now, that said, there's always an expected sort of maybe written or even unwritten rule of use of proceeds, and certainly for early stage investments or later stage, the bigger, the smaller, as companies are forming and thinking about down the road, I thought it would be a good idea to have a discussion about use of proceeds for sort of education of what the mindset is of the investors on what might be appropriate. And since you've been at this for quite a while, I thought it would be good to have your take on that. So what are your thoughts on use of proceeds, Marco?
Yeah, and that's a really good distinction. The world I come from, while I have a fair amount of experience in the grant world as well, most of my experience has been in the other people money realm, specifically equity. And when you're talking about handling other people's money, you're talking about a number of things. Just to draw a fine line with what you said, Rob, that's a great distinction. When you're taking federal money or other sources of capital that have compliance components, such as crowdfunding, the SEC has a Form C, which basically requires very specific reps and warranties on use of capital. Here in the tech world that we live in, that I live in, we're looking for, I think, a couple of attributes, and I've got a list prepared here that I'd like to talk to. But I'm looking for, at the end of the day, I want to see that people have done their homework and have clarity on how they're going to use specific amounts of money to what end, and I want them to do so in a way that inspires confidence by the investor and the entrepreneur. So if you think about it, we can tell, and this is one of my favorite topics, use of proceeds is really where the rubber meets the road with investment capital. We're really trying to get a sense of, does the entrepreneur have a clear plan, and as they've done, back to this point of communicating their homework readiness, have they done that, and then are they able to communicate their priorities for the use of other people's money? So to me, this is one of the most kind of critical parts of ground truth with dealing with entrepreneurs. And Rob, I'm of the view that the more specific, the more transparent, the better. I'm not suggesting that we get into screwdriver levels of detail with use of proceeds, but I do want to know directionally, how is the entrepreneur, what are the top 2, 3, 4 areas that the entrepreneur is going to spend money in, so that it takes me, the investor, to a place where I know the entrepreneur will retire risk and arrive at a meaningful milestone. So in other words, if we do A, B, and C, we will achieve the following objective as a company. So that really says, hey, there is clarity about where the entrepreneur was, where they want to go with the investment, and I get a chance to see if I agree with that use of capital or not. It says, hey, this guy is judicious, disciplined, and they're trustworthy, and I really want to know that all of that analysis, a $500,000 investment, for example, is really tied back to the expected financial needs or forecasts of the entrepreneur. Does that make sense? So I can go on with this topic, but for me, if I were giving tips to the entrepreneur, I would be of the view that you really want to be specific with a number. For example, tell me that you want to invest $500,000 to do A, B, and C, for example, product development, sales and marketing, and maybe some more detail behind that. But what I don't really necessarily want to see is $500,000 to $1 million. There's some ambiguity in that. I'd rather get to the point, especially in the first early investment, that there's clarity on what we're trying to achieve, and the entrepreneur is on the same page with me. There's another nuance here. At the end of the period, the investment period, I want to know how well that entrepreneur has performed, because this will tell me, and this is a big hint for success for entrepreneurs, this will tell me if that entrepreneur is ready for prime time on the next round. If they've done a great job, for example, managing the capital judiciously and getting to a meaningful milestone, that's terrific. That signals and inspires confidence that this entrepreneur knows how to do business. Now, I certainly have more than just the follow-on conversation to add to this. There are plenty of examples of how entrepreneurs can effectively take a use of capital thesis and convey that into a follow-on investment where larger amounts of money are at stake. So that is what I would suggest to the entrepreneur: be specific and have a plan.
So when we talk about use of proceeds, you were mentioning some of the categories that they should consider stating they'll be using this. Now, this is usually in the discussion of, how much money do you need to accomplish certain goals? As an early stage investor like CIT, we're going to be typically the first in that first round, or even the only money going in. Typically, we're investing in rounds, of course, but an early round. And so what don't you like to see after you make an investment and you all of a sudden are there instances where they think there's sort of a, how definitive when they get a $500,000 round and we're maybe at 100K, and all you get word of trips or parties or those sorts of things that weren't discussed in that original discussion. Now, how much insight does an investor have into the use of how companies spending their money typically?
Well, that's a great question, Rob. And first, let me just say that there really is no single template that satisfies every situation. But I, as the investor, while I don't want to micromanage what an entrepreneur is doing, far from it, I want to give that person latitude to do the types of decisions they need to do to be successful. There has to be some flexibility. But I also want transparency. I want to be able to get a good sense that what we have is truly use of proceeds that are aligned with the originally stated objective. And we jokingly say there is a term that I use as abuse of proceeds, and that can take on many different forms. is some of them are in the realm of just not judiciously managing capital. And you've already stole my thunder on a few of them, but clearly, if you think about if you were investing your own capital, would you be, for example, investing in a launch party or certain types of tchotchkes, which may or may not be appropriate at a very early stage in the company? There may be instances where the entrepreneur is burning cash just too fast and runs out of capital well ahead of schedule. Some of these things you can fix, but running out of capital beforehand you can't fix. You can be stuck very quickly. So I'm not suggesting that changes can't happen during the course of an investment cycle. The things go bump in the night in startup land, and that's completely understandable. But there are some areas that tend to not set well with other people's money, and that is, for example, excessive compensation that's not commensurate with the stage or the market of a company. Or to you, I think you mentioned parties. There are many examples. I've seen expensive car leases on company books in a prior life before here. And my point in saying that is those sorts of actions don't necessarily reflect well on the entrepreneur. And if you really take a self-interested perspective, if your objective is not only to increase the value and retire risk of the company, taking a longer view, you're thinking about raising more company downstream. So I think one of the objectives in all of this is not only shepherding the capital in a way that gets you to that objective, but also signaling to the other sources of capital, not only in, but even prospective investors, that says, hey, the money got used well. And by the way, if there's a larger investor involved in the future, guess who's going to be the first phone call to discuss how the proceeds were used in the prior stage? So I think it behooves the prudent entrepreneur to avoid that whoosh sound when the abuse of proceeds happen. They don't happen often, but they do happen. And Rob, you raised a really good point about the federal side of this. We at CIT, we are in this fund, we behave and function as we are fiduciaries. We behave as a market-based seed and early stage investors. But if the entrepreneur does take, in the form of federal grant money, for example, SBIR, et cetera, there are very precise reps and warranties that the entrepreneur, it's a covenant that the entrepreneur or applicant is entering into with the government. In that case, there is a very clear expectation that you stay in your lane with the communicated uses of proceeds. So that is also another level of seriousness you want to take in this topic. But I think for those who really are most interested in doing this properly, I think it comes back down to just a handful of principles to keep in mind. Do your homework, communicate your priorities clearly, inspire confidence as you execute against the use of proceeds. And if things go bump in the night, be transparent and communicate that to your investors.
And I think the interesting thought is, that an early stage seed round or a $500,000, $1 million round is typically not the exit. I mean, that's not, the company's not ending at that point, and there's got to be probably maybe another follow-on round. So as companies have, it's your chance to show both the investors that you're currently with as well as prospective investors that you're a good steward of money. You can spend money, you can hit milestones at that early stage, and you're doing it in the way that we had planned. And if it wasn't the way we had planned, that's probably some communication with those investors before you spend the money in another way, so that everybody's on open kimono, so to speak, that everybody's on the same page, so that when you need another larger round, follow-on round, that those early investors might have an opportunity and interest to make another investment if they think that you've been a good steward of the funding to date. And so I think that's what you have to be driving towards is that, I think
that's right. That's right, Rob.
And so from that, are there any other last minute kind of thoughts or tips that you'd have?
Yeah, no, Rob, I would just kind of say this as kind of a closing comment. In our experience, whether we're talking about cybersecurity or UAS or software in general or energy deals or life sciences, it does not matter. These principles apply. And at the end of the day, to use your metaphor and to build on your metaphor, I've heard the metaphor of croquet being used. Each round can be thought of going through a croquet wicket. And when you think about growing the value of the firm and retiring risk, you're going to play the entire croquet circuit. So think about each one of these wickets as a use of proceeds window, and you are trying to create greater lasting value for yourself and your investors and other equity holders in the company. So I think if you follow these principles throughout the life of the investment, you'll be in a good place.
Well, I thank you for your time today, Marco. If anybody has any questions about our investment fund, certainly you're willing to contact Marco. His contact information is on our website. You can also contact me at my contact information here on this slide. CIT.org is our main website, and you can find our different initiatives for all of our programs on our main website. We have several ongoing, every quarter or so, we've got events for our training classes for the SBIR programs, of which time our investment directors usually come out to some of those training classes as well, give the opportunity to introduce yourself to them. So with that, I wish everybody luck and goodwill in their seeking of venture capital. And if you have any questions about seeking venture capital and you're in Virginia, CIT does work only with Virginia-based companies. Feel free to reach out to us. We'd be happy to talk to you. Again, thank you for your time today, Marco.
You're welcome.